Welcome to the Credit Clubhouse podcast, a deep dive into the world of credit markets and alternative finance. Before jumping into our next episode, we have an exclusive offer for our listeners. Just head to dealcatalyst.io, pick any event, and then enter the promo code CREDIT at checkout. This will provide you 10% off any ticket to any conference. This offer is limited to the first 50 ticket buyers. Don't forget, we want you to follow the show, rate us, and leave a review. We encourage your feedback, and we want to hear from you, the listener. The next episode is presented by 9fin. Every day, you're making decisions that matter. Which credit to buy, which deal to pitch, which covenant terms will hold. You need the right intelligence, you need it fast, and you need to trust it. That's where 9fin comes in. One AI-powered platform with complete visibility across public, private, and distressed credit, built for how credit teams actually work. Head to www.9fin.com/demo to request a 30-minute personalized demonstration. Again, that is www.9fin.com/demo. And now, on to our next episode. Welcome back to the latest episode of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content Programming at Deal Catalyst. Joining me today is Michael Haynes, Head of Private Credit Strategies from Beach Point Capital. Michael, really appreciate your time today. Thank you for joining me, and looking forward to our conversation.
Pleasure. Thanks for having me. Looking forward to it as well.
So, given the, up and down or tumultuous year, I guess you could say that private credit had last year, kind of where would you say the competitive environment is, especially in more of the direct lending market right now?
Sure. And I do think it's necessary to distinguish between the direct lending market and more sort of opportunistic strategies.
Yep.
They're in the same environment sort of, but they have different headwinds and tailwinds. And I'm happy to touch on that later on in the discussion. But yeah, let's start about talking about direct lending. First off, as a general matter, some of I would say the kind of narrative around direct lending is, tighter spreads, more competitive environment. And undoubtedly that's true insofar as we're comparing it to the last year or two. But of course, direct lending's been around for a long time. So in the last year or two, we could say, yes, lots of capital's been raised for the asset class, some from more retail investors. That's been kind of a new phenomenon at scale. And has the outcome of that been directly or indirectly a tightening market? Yeah, sure. Look, like high yield is in the 90-something percentile of spreads, and direct lending is not that tight. I would say it's sort of around its historical average for spreads. So it's tighter compared to the last year or two, but I would say is still, easily kind of a 5 out of 10 environment. And so more competitive than it was, but still, I think largely a healthy opportunity set. I'm going to touch on for a moment just kind of why I think that and where that comes from, so that we're not just kind of talking about spreads in a vacuum. If we're talking about direct lending, and in particular sponsor-backed direct lending, the feedstock for that is the private equity industry. So let's just touch on that. It's something like a $13 trillion market. It is enormous. Last year, something like $500 billion was raised for private equity strategies. And so that $500 billion probably created at least another $1 trillion and probably more like $1.5 trillion of purchasing power. So awfully large amount of potential transactions from the capital closed just last year. In comparison, direct lending, despite this narrative we have that there was so much capital raised about $120 billion. And so, we're talking about a private equity industry that probably raised enough capital to support easily $500 billion to $750 billion of financing activity. And direct lending raised $120 billion. that's a decent but not irrational market share anyway. Um, Even if all it was doing was financing new deals, not even financing kind of existing capital structure. So that's one framework to think about what's going on in the market. The second framework, to think about what's going on in the market is, to segment it a little bit. By that I mean the vast majority of the capital was raised for large cap transactions, and that is the market that I have observed having the most sort of competitive tension, where large cap private credit is now, they're not competing with each other, they're competing with investment banks and underwriting multi-billion-dollar deals. And so that's a different layer of sort of competitive intensity. Where we play, which is more in the middle market, we haven't really seen that. We haven't seen anywhere near the quantum of capital raised, and we have not, as relates to competitive intensity, really seen an increase in the number or competitiveness of our peers who we see looking at similar types of transactions. And so even more so, you have to sort of spread out which markets you're talking about, and they all have kind of different dynamics. The last framework I'll touch on just for a second is, what is private credit's market share? Right now, private credit in the US is about the same size as a high yield market and the syndicated bank loan market. To me, that feels like a rational division of labor amongst the markets. And over time, they're going to compete with themselves. Last year, give or take $80 billion of syndicated loans got refinanced by private credit loans. $80 billion of private credit loans got refinanced by syndicated bank loans. So, market share will wax and wane a little, but you've got market participants who have capital to deploy, and they compete with each other. And where capital is flowing or where best relative value is kind of migrates over time, and will change depending on the market cycle. And so I think it's best thought of as another of a growing one of the market participants that will be out there competing for their share, all in a backdrop of a market that's kind of plenty big to accommodate the capital that's been raised and create enough opportunity set to keep that a healthy market. The last thing I'll point out is one thing that's really, really helping, and that I think is making, like historically tighter spreads more appropriate and palatable for investors, is there's just a lot more data on the private credit industry overall. When Beach Point started being involved in this market and we'd be sitting with clients, they'd often ask me, hey, do you have any ideas for any index we could look at? Like, where do we actually study how you're doing versus your peers? And my answer would be like something like, mumble under my breath, yeah, I have no idea. And today there's a number of different indices that track amongst a ton of different general partners, loss rates, cash interest versus PIK interest, trajectory of EBITDA and financial performance of underlying credits, trajectory of leverage levels over time, and so forth, and can really start to map out first of all, effective managers from less effective managers, and second, the overall health of the market, and can benchmark more appropriately. And that is all creating a lot more comfort with the industry overall compared to its kind of public market equivalents. So those are all,
And I know it's not equal, the public and private, but they're starting to look like each other a bit more. But the data transparency piece, and having insight into the market as a whole, obviously that's increased. How much more do you see that kind of developing? And I don't think it'll ever be on par with the availability of data in the public markets, but do you see us kind of getting a bit more even there? And does that make private less appealing because there is an element of private, you're getting a premium for it?
Interesting. It's an interesting question. Let's talk about transparency, and that can mean different things to different people. If you're talking about general partner transparency to our borrowers, in a sense, that's better. I mean, there's a private loan, so our access to private data, I would say, is better than the disclosure we tend to get from kind of your average broadly syndicated loan issuer. High yield issuers tend to be a little more useful in disclosure because they're subject to securities laws and so forth. There's a little more of a statutory obligation to disclose. But I don't think private credit suffers from limited to disclosures to lenders. To the contrary, I think it's better. Now let's talk about the transference of that disclosure to our underlying clients, let's say institutions or high net worth, foundations, endowments, and so forth. Mm-hmm. We provide as much transparency as we're allowed to on a portfolio level. It's a little bit hard to do that on an issuer level because these are private companies and we're subject to non-disclosure agreements and so forth. But we, and I think our peers, are a lot more comfortable working with some of the index providers to allow them to aggregate more sort of comprehensive data on the industry, because that only helps our clientele get comfortable with the asset class overall. And so, and that has improved in recent history, and I think will continue to improve as you have more data on cohorts and manager differentiation and some of the other things that will help, distinguish, kind of the effective managers from the less effective ones. And so all those things are going in a positive direction to the market overall. How will your average, let's say, public market BDC stockholder feel about the disclosure of credit information on the underlying credits there? It's tough to say. There's always going to be some limitations there. Generally, I think BDCs are pretty effective in communicating their credit trajectories and outcomes, and they're audited businesses and tend to be required to disclose loan loss reserves and to at least reasonably approximate fair market value on their marks and so forth. And so I think that will help. There's been some discussion about the development of quoted markets for private credit loans, creating price transparency. I'm not sure I'm so convinced that will become frequent. There will be some loans where maybe you'll have broker dealers quoting them, but for your average middle market lender in particular, I don't see who that really serves. And so I'm less of a believer that somehow that's going to be a common characteristic of the market. But I think in general things are getting a lot more transparent to a number of different constituencies, and that should continue.
You're digging a bit more into kind of the direct lending market today. Obviously, you mentioned BDCs; they're clearly down. As of late, and at the time of this recording, obviously the technology sector has taken a pretty big beating. I talked to someone this morning who called it a SaaS apocalypse. So I don't know if we're at that point yet, but I thought it was a funny term that was used on a call I had with someone earlier.
SaaS apocalypse.
Well, I mean, what are your thoughts on kind of some of these sectors? And obviously some have taken a bigger beating than others. Are there any other areas that maybe provide unique opportunities? Maybe dig in a little bit into some particular areas within the market today.
So let's just talk about software, and then we can talk about some of the other areas in the market. But that's I think a discrete phenomenon. The most interesting thing is, other than a new release of Claude vibe coding tools, this is not a risk factor that's been a new thing to talk about in the last 3 weeks. This has been a condition of the market and a discussion of the credit markets for a year, and in our case, several years. And so it's interesting how quick I would say the transmission mechanism is between a little bit of fear and technology development and the market's reaction to that. I kind of raise my eyebrows just to give you some examples. BDCs, some of them are trading poorly, but if you're looking at a sort of example of a BDC ETF, there's several of them that are trading down a couple percent. Is that dramatic? Not really. Certainly not in keeping with kind of the overall, I would say, the narrative that's out there about the SaaS apocalypse. So it's kind of interesting. And on the other hand, you see in sectors like insurance brokerages that are, lest we misunderstand, not SaaS companies, that are getting absolutely destroyed in credit markets because of a concern about an entire industry disintermediation. And so there are definitely, pockets of volatility that are going to emerge as this technology advances. And I think that's just going to continue to be a characteristic of our market for some time, because this technology is advancing more rapidly than probably any I've seen in my lifetime. And who the winners and losers are. Beach Point's background is to have success in generating views on winners and losers, and I think we'll do that in this environment. But that's going to create some volatility. I happen to think, high yield pricing and credit market volatility is tight and low and not particularly healthy, given all the other things going on in the world. So I happen to think it's maybe, healthy for there to be some form of adjustment. But that's going to be a feature of the market for a while, and we all better, strap our seatbelts on, because I think we're going to continually see industries over time that end up being heavily impacted. I'll make a couple other observations on this topic. One is, while there are specific companies or sort of subsets of industries that have been more impacted, I'm not quite sure that's what's happening in the market. I mean, to the extent that BDCs have traded down and some SaaS names have traded down in credit markets, our trading color would indicate that what we're seeing is a lot more about industry de-risking. Let's take it for an example, a chief investment officer who says to his portfolio, or who says to their portfolio manager, hey, that portfolio running, it's 20% software. It's a little hot for me. Please reduce your exposure to the sector. Yeah. Portfolio manager goes to the trader. Hey, my boss just told me take 20 to 10. Go figure out what you can sell. And so I think that there's a fair amount of de-risking more broadly in what's happening in markets, in equity markets and credit markets and so forth, without a huge amount of specific differentiation in business model, competitive modes, revenue model, beneficiaries of AI versus sort of casualties of AI, and so forth. So it's a fascinating subject. I suspect we could spend multiple podcasts just kind of talking about the various ramifications of AI on the economy more generally. It's a fascinating topic, and one that I think, like the telecom crisis in sort of the early 2000s, will create a lot of winners and losers in the manager universe.
Obviously, private credit has seen a significant growth the last 5-10 years overall, and the amount of capital going into the market has obviously increased, and some people will call some tourist investors entering the market. And has that changed anything when it comes to structural protections and covenant, cov-lite? Have you seen deals become a bit more, I guess, what would you say, against what you guys normally would see, or is some of that maybe overblown and it's kind of a natural evolution of the market? You'll see some extra investor interest ebb and flow, but structurally speaking, it hasn't dramatically changed.
I'm going to distinguish between direct lending markets, which are one answer, large cap direct lending markets versus mid cap or lower middle market as another, and then more the opportunistic side of our business. Let's just talk about large cap for a second. Yes, there definitely has been, coming from sort of the interest rate hiking cycle, some flexibility, additional flexibility written into credit docs. And some of that is competition. Some of that is a normalization of docs that I would say had tightened quite a bit by historical standards. And top tier sponsors, when they're talking to their lenders, their creditors are not writing docs. Their creditors are handed a doc by the sponsor and told, here is our doc. Are you comfortable with this? There's a few particular law firms that I won't name who are the authors of those docs, who are pretty good at making a change in a deal that is creditor unfriendly, and then in the next deal arguing that that's the new market. So if they are listening to this, they will know who they are. But that I don't think has really helped the environment all that much. We have started to see two other features in very large cap deals. One is, covenant light deals, but that's nothing new. It's been around for a while, and top tier sponsors almost inevitably will demand that. The second is, this is less, I would say more of an issue. We've seen transactions where sponsors are asking for a PIK interest option, even if their business plans don't need it. So think of that as we're asking for it because we can get it, not because it's a part of the financial need or a part of our business plan or anything else. And lastly, there's varying degrees of quality of earnings and add backs and so forth. And all of those have, I would say, in general, trended towards being less creditor friendly than they were 2 years ago. Would I say that they're, poor by historical standards? No, I don't think so. And they're still better than their syndicated bank loan equivalent. So, you can still regard that as a benefit of private credit versus a public market alternative. It's just a little less kind of beneficial than it has been. We have not seen that same pressure on middle market docs. That tends to be more of a commercial negotiation where borrowers there would tend to take, the point of view, look, like this isn't really relevant to me. I'm never going to do that. So I'm not going to bang my head against the wall about, getting flexibility for it. There are exceptions to that, but generally I'd say there's been kind of less doc pressure in that part of the market. And lower middle market, none at all. Lower middle market borrowers, because of their size and sophistication, are generally comfortable with the traditional document served up by the private credit industry, including financial covenants and so forth. So you kind of have to modulate your expectation depending on where you're trying to play. Yeah. In the opportunistic part of our business, it's opportunistic and offering us a yield and economic outcome that's, a lot more attractive than a general, sort of middle market senior loan, because we're willing to accept additional complexity. That could be complexity of balance sheet, complexity of industry, complexity of shareholder structure, or whatever. In those cases, since these are companies that are not traditionally bankable anyway, those docs are all bespoke and do not suffer from sort of, I would say, market variations in what terms we can or cannot get. And so, it's a broad range of outcomes. And honestly, like I mentioned before, in terms of where the industry is competitively, that'll go through cycles. If there's another interest rate hike cycle, businesses will be more difficult to finance, and we'll start, tightening docs. And even in the large cap part of the market, those will get tighter too. And when capital becomes, more liquid and more available, and spreads come in and so forth, we'll see, the opposite dynamic. And so I just encourage all the listeners out there. It's a market. It's a competitive market. It will vary like any other market. For those of us who've been in this industry for decades and have seen market cycles, we'll all have, general sensitivity to and experience with, not getting too comfortable with any of today's environment, because we're not sure which way it's going to change. It's always going to change a lot.
Feels like it's maybe the reaction to the change is a little more overhyped or overblown than it might have used to been, or the change might be happening quicker or than it used to be. But moving on to some of the risk indicators or signals, like what do you monitor most closely when looking at risk and other signals when it comes to your portfolio or the market overall?
One of the in terms of the types of signals we look for and risk management more generally, one of the huge benefits to our private credit business is that business being fully integrated into a broader platform. And I'll give you some context for that. At Beach Point, across our business, we own hundreds of different names. And our industry analysts are covering thousands of different names, illustratively speaking. And every single one of those names, whether we own it or we've covered it, are offering their own individual data points on trends, supply chain, regional demand, industry trends, national trends, demographic trends, margin trends, cost input trends, and so forth, inflation indicators. And so, and then the color we get from management teams on outlook, distilled amongst those hundreds of names and in our coverage universe, thousands of names, all distill into, I think, a really useful and necessary series of underpinnings to the credits we're looking at, whether in public or private markets. We see corporate finance, we see structured finance, we see real estate finance. We look at companies benefiting or being disadvantaged by macro factors. We look in private markets, public markets, higher quality credits, lower quality credits, the US, Western Europe, and so forth. And so all of those things filter into our credit analysis. And so as relates to sort of specific risk indicators, I don't think there's any that we're always kind of focused on specifically, but rather aggregating from such a broad universe and distilling that down amongst the entire team here into themes and areas of concern and so forth. As relates to kind of today's specific emerging risk factors that that we are paying a lot of attention to. Look, we talked about the SaaS apocalypse, so I won't rehash that. Other than on a derivative basis, the first one outside of software, I think we are in a period of particular geopolitical risk. The current administration is attempting to recast the global order, and since that is the order that has existed for my entire life and for most market participants' entire lives, it is difficult, I think, intellectually for anyone to have a firm or confident view of exactly how that will play out. As applied to, let's say, Taiwan, who are still the world's leader in chip production, as relates to scarce commodities, as relates to trade flows and capital flows, which have influences on currency, global interest rates, the dollar as a reserve currency, and all things that definitely influence credit markets every single day. And I do not happen to think that is priced into liquid credit markets. And it's an area of discussion here and an area of uncertainty. And I'd love to say Beach Point had a highly refined view. We do not. We study it carefully, and it influences our overall sense of where risk premia should be without needing to have a specific view of exactly how it's going to play out. So that's one factor. Second factor, also I do not think is priced in today's credit markets, relates to AI, but only on a sort of second or even third derivative basis, which is to say the amount of tasks that are discussed as disintermediating industries are bad for the financial performance of those businesses, but they're even worse for the employment base. And so the amount of potential job attrition, and then beyond that, the political ramifications of that job attrition, I think are difficult to understand. We have millions of professional vehicle drivers, and if anyone's been in a Waymo, it's easy to conclude that autonomous vehicles are safe and effective. I could rattle off another of other industries, including some like software programmers that would appear to be a high comp universe of professionals who are in danger of having their skill set sort of degraded by AI in terms of the rapidity of advancements in AI coding capabilities. And so the political ramifications that we had a candidate not too long ago named Andrew Yang who proposed universal income. How does one solve the immense wealth gap and the potential for a vast amount of unexpected unemployment? I think that creates uncertainty as well for markets overall, and certainly for some industries in particular. So that's another area of risk that we talk a lot about. There are varying views even at Beach Point. And again, without having a specific conclusion as how it will play out, that should influence investors' concepts of appropriate risk premia and what they should be getting paid. In particular, in private credit, where oftentimes you're taking 5, 6, 7, 8 year risk.
Yeah.
Anyone who thinks they're capable of predicting the development of that technology over 5, 6, 7, or 8 years should be a venture capitalist and not a credit investor. So, and I'll give them money if they're really so convinced that they're right about that.
Yeah, exactly.
So anyway, a couple things that I think are most reflective of the macro discussions that we have. And then at Beach Point, on a more narrow basis, there are always things that influence us. Housing is a big influence on many sectors of the economy, building products, some services sectors in particular. Regulation, in particular, the healthcare industry is a big one, and we're constantly on our game in understanding the trajectory of state and federal regulation as relates to healthcare as well.
What advice would you give to investors who might be new to the private credit space today?
Understand first. Let's talk about direct lending. Again, I'll distinguish different areas of private credit. Direct lending is a core asset class. It is an income product. Its nature is with low volatility and high visibility to offer investors who are willing to accept some illiquidity a premium coupon. That's its mandate. And in order to do that well, investors need to accept a medium-term asset class, which is to say, if you're investing, make sure you're comfortable having your capital locked up through the life cycle of a loan portfolio. And to make sure that your expectation is, while you're doing so, expecting a minimum volatility, there are going to be cycles in which there are going to be credit losses or impairments. And for that reason, have the patience to play through that cycle with good managers who have a history of working through those and who have the capability of working through problem credits. Increasingly, I think that will be a core skill set of the industry. As its market share expands, differentiation amongst managers in terms of how well they work through poor credit cycles or problematic credits, I think is going to be one of the key determinants of who's a top quartile manager and who is not. Our firm has invested disproportionately in those resources across our broader credit platforms. We feel good about our chances with that as a differentiation, but at heart, that's getting to, you're investing in a core asset class and you really don't want to take any losses. So it's our job to as nearly approximate that outcome as we can. Above that, I would encourage investors to think carefully about the nature of the structure that they're investing in, which is to say, if you think back to the global financial crisis, there are a number of mismatches in the hedge fund industry. We call the asset liability mismatch, right? You got, investors thinking that they were in a liquid product and they went to redeem their capital, and the assets turned out to be nowhere near as liquid as necessary to meet those redemptions.
Yep.
Today, there are drawdown vehicles. Those lock up your capital for a while, but they do not suffer from asset liability mismatches. So that's a plus and a minus. On the other end of the spectrum, there are open-ended funds that enable you to generate liquidity, but do subject you to being subject to other investors' sort of liquidity demands and could potentially have those asset liability mismatches. I would call those less optimal structures. And then in the middle, there are so-called evergreen structures that are open to investors generally at all times, but offer liquidity through a form of sort of managed redemptions where you can get your money back, but then you get liquidated over the course of the portfolio that exists at the time that you submit your liquidation request. And so that would tend to pay you out as the loans liquidate, but do not subject other investors to your decision to do so. I call those, somewhat of an optimal solution for this type of asset class. But whether you like our answer or any of our peers' answers, making sure you're not subject to an asset liability mismatch would be a good way to avoid prior products mistakes.
Are there any other? I know we've focused a lot on the different segment of direct lending. Are there any other strategies, whether it be CRE, ABF, fund finance, that you see as a growing opportunity emerging?
Yeah, we're involved in all the ones you mentioned. Commercial real estate, we've had a vibrant business for a decade plus. Actually, amongst all the different asset classes, I'd say that is one in private credit that perhaps offers superior relative value by virtue of there being a big market participant, regional banks, who are just a lot less active in the space than maybe they had been in prior cycles. And so our strategy and others there is really filling the vacuum created by the pullback from sort of the regulatory environment. ABF investors are catching on to the virtues of having a lending strategy that has specific hard assets underpinning. Beach Point has been involved in ABF for quite some time, and in our case, we're particularly focused on non-agency mortgages and have a long track record in that. And I do find that to be interesting relative value. Fund finance, we're actually incubating right now. It's not out. That one feels a little more transient to me, meaning it's available in a cycle where there happens to be a backlog in fund distributions precipitating a need for fund finance, and that feels a little more transient than, say, mortgage lending, which will be around in perpetuity, but is interesting. And there are a number of private equity managers, generally who fall in the lower middle market or the middle market, who could use some additional liquidity into their portfolios and are willing to borrow money at interesting rates because that's still accretive to their much higher returns targets. And so we're cautiously stepping into that as well.
Before we jump to our fun questions as we begin to wrap up, I did want to ask, if you could share any examples of lessons learned or, something that, in a deal that didn't go as expected, kind of what was something that you can at least talk a little bit about without mentioning maybe specific names, but curious to kind of what you might have learned from something that didn't go as planned.
Beach Point never makes mistakes. Everything goes as planned.
The perfect private credit job.
It's really funny, like I had a conversation with a peer. This is for one of our strategies that's got, a mid-teens return target. And if you're earning that in credit, you're agreeing to accept some risk. And so the question was, in your portfolio, what percentage of that portfolio do you expect to, have issues where you're engaged with the borrower and working through issues? And, I kind of chuckled and said, in our opportunistic strategy, if you're lending money at those rates, it doesn't happen this way, but you should expect most of them to have those types of issues. And so, over time, one of the things that we've gotten a lot more conscientious about is just shortening our term and having a much greater comfort in visibility on exit strategies. It's easy to lend people money and decide you're quote unquote covered and there's value to pay you back. And if you had to own the business or asset, maybe that wouldn't be the worst thing. But that's not really telling you who's going to take you out of your capital. And there has to be some transaction that does that. And over time, we become a lot more, I would say, discerning and disciplined on having a specific exit strategy for everything we do. And so, that has created some lessons learned, not so much in the context of losses, but just term of investment, like things that we preferably only wanted to be in for 3 or 4 years, and 6 and 7 years later, we're probably still covered, but we're still, struggling to find a way to exit our position. And so that is in less liquid credit, something that has been somewhat of a micro change in how we approach things. And I think it's made our overall fund strategy in the opportunistic part of our business a lot more effective, and has provided us a lot more sort of visibility on capital returns and so forth. So it's been, in that sense, I think, a good outcome for our clients as well. On a fundamental credit level, across a team at Beach Point that's worked together now for a long time, our basic lessons learned are always around patience, which is to say, never be sort of too high the great investments or too low on the poor ones. To do your homework up front, to have a plan in place for eventualities, even if you don't necessarily predict them to be your most likely outcome, and to make sure you have the resources around you to facilitate any of those plans for the same reason. And so we invest a lot in resources that help us not just sort of underwrite credit, but also work through them. We invest a lot in a restructuring team. We invest a lot in a team here that's our hybrid strategy team, a lot of whom have private equity backgrounds and based on their careers, work very, very closely with management teams and boards of directors and value creation plans and so forth. And all of those are just kind of the maturity of the credit markets overall and private credit in particular. When it was really sort of a brand new industry, it was so new to borrows and there was so little competition that I think you could kind of get away with just being more of a, I'll say, a sales business than an investment management business. We were offering something new. It was kind of interesting. Private equity sponsors tried it on. Sometimes it worked, sometimes it didn't. But today's market is not that. It's filled with a bunch of savvy competitors, and our job is to kind of stay in front of the pack. And so all of those are kind of, multi-decade lessons learned in aggregate.
We have just a few minutes left here, so I always like to end a little bit more lighter with some fun questions, a little rapid fire. Favorite sports team and or hobby?
I'll go with both. Favorite sports teams. Sadly, I grew up just outside of Washington, D.C. in Maryland. And so I grew up a Washington Redskins, now Washington Commanders fan. And the turnaround from 2 years ago to last season it was just sad. I don't know how else to describe it. It was just depressing. But new ownership group, Josh Harris, if you're listening to this, please continue and invest in the team. And come
on the show.
high hopes for Josh Harris and the Commanders overall. And then the only sport I ever played well was soccer. I was a collegiate soccer player too. So I'm a massive fan of and a small part owner in a Premier League team called Burnley Football Club. They have gone back and forth between the Premier and the Championship, and I think are likely to be headed back to the Championship. But still great fun to have such a spirited fan base, and so really enjoy that. As it relates to hobby or maybe strange things for people to know about me, in my spare time I like to climb mountains, and I'm a technical rock climber, and so some winters and summer weekends and so forth, you'll find me dangling from ropes in all sorts of uncomfortable circumstances. And
what about skyscrapers?
I've never climbed a skyscraper. No. and since my wife is probably going to listen to this, I always have a rope on, I promise. It's one of those really mind-clearing activities that require focus and also require completely disconnecting from everything else going around you. So it's one of the reasons I find it so enjoyable.
One book you'd recommend reading?
Oh, geez. For today's sort of environment, because it was on my high school students' reading list, I read Frankenstein. And Frankenstein in the context of aspirational technologies as a metaphor is a very, very fascinating read. And it is not surprising to me that someone just produced a Frankenstein movie. The metaphors are eerie when you think about all of the risk factors that people talk about today. And so I'd encourage everyone to read it with that metaphorical mentality.
Most exciting part of your job?
The people. When I started the New York office at Beach Point, it was just me. It's now 45, going on 50, going on 60 people.
Wow.
I've hired 22-year-olds who now have wives and kids. I've watched people go through cycles of their career. I've watched people leave Beach Point and go on to be, very senior members of various presidential administrations, advanced degrees, and just seeing the sort of broader Beach Point family has been the highlight of my career. It's kind of why I come to work every day.
And then final question, one prediction for the next year. Welcome back.
I'll make a prediction as relates to credit markets. I happen to think this will be a good year for credit market performance. And I would say that is somewhat out of consensus. I happen to think that we will see some decline in the rate environment. And I say this because I do expect there to be some pressure on employment, and I expect economic growth to be good, but employment to be a little more under pressured. And the knock-on effect for credit markets is a declining interest rate. I think environment will be healthy for the overall picture. And so I'm quite bullish, and for what Beach Point's doing, I think it's maybe it's not a 10 out of 10 environment, but there are some things we're doing that are reasonably attractive. So I'll predict a pretty solid year of performance for us in particular.
I think that's a good way to end it. Michael, I really appreciate your time. So thank you for spending a few minutes with me here today. Continued success to you and the team, and hopefully we'll get you back sometime in the future.
Thank you. Love to come back. Appreciate the discussion, and looking forward to the next time.
Thank you. Thank you for listening to the Credit Clubhouse podcast. The Credit Clubhouse is brought to you by Deal Catalyst, the leading capital markets events and market intelligence company. For more information on Deal Catalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.io. Thanks for listening. Until next time.